Good morning, good afternoon, everyone, and a warm welcome to today's FinTelect webinar on evolution of financial crime risks in 2026, from sanctions to shadow fleets, which we are bringing to you along with our knowledge partner, LexisNexis Risk Solutions. For those of you who don't know about FinTelect, we are a specialist in anti-money laundering and countering the financing of terrorism, training and capacity building. We've been operating for over 2 decades now. I am Arpita Bedekar, partner and chief operating officer at FinTelect, and it's my privilege to be your host for today's session. Let me also introduce to you our esteemed panelists for today. We have Ji Meng Chen, Head of Financial Crime Compliance from CIMB. He's joining us from Singapore. Hi, Ji Meng. Then we have Rohit Mittal, Director, Market Planning, Financial Crime Compliance from LexisNexis Risk Solutions. Thanks, Rohit, for joining.
Thank you for having me.
And we also have Ryan Bautista, Head of AML Compliance from Union Digital Bank. He's joining us from Manila, Philippines. Hey, Ryan, welcome and thanks for joining.
Hello, thank you for inviting me here.
So we actually have LinkedIn profiles of our three speakers that we will be adding to the chat box. So you can please take a look at their profiles and also join their LinkedIn networks if you would like to. So we also have a large number of attendees today, I think from close to 50 countries, and that says a lot about the importance of the topic. So what we've planned is a panel discussion for about 45 minutes, and then we'll open it up to questions from our attendees. So friends, please keep posting questions along the way. I would highly recommend doing that in the Q&A box, which is present at the bottom of your screen. I'm saying that because the chat often gets very crowded and there's a risk that we may miss your question. So please add it to the Q&A box. So without further ado, let's dive right into the conversation. The topic today that we've chosen is the evolution of financial crime risks. And especially with today's fast-changing geopolitical situation and the vulnerabilities that it is creating, I think it's a very relevant topic for discussion. Already we are seeing, black markets booming around the world, fund movements are changing, maritime trade is highly impacted. And I think consequently, there's a need for institutions to pay even closer attention to transactions and the need to deepen the level of scrutiny in customer accounts and transactions. So what we'll also try to do is to look at practical steps that compliance teams can take to strengthen their frameworks across screening and monitoring and investigations. So I'm going to start with Rohit. And Rohit, I'm going to request you to provide a quick overview of the shifts that you have seen during the year. And, given that your work at LexisNexis would provide that high-level insight on what's happening globally across institutions, could you also cover some of the sanctions evasion techniques that, are commonly being used? So Rohit, over to you.
Yep, absolutely. And thank you, Arpita, for hosting this. Definitely a very relevant topic in today's world. Uh, Coming to the shifts that we are seeing in 2026, so one of the most notable shifts is sanctions evasions has moved away from simple name concealment towards network-based camouflage, and this is something that we are seeing more often, especially with the changes in the global world order. So many conflicts happening around the world and rerouting of supply chains post-COVID and so on. So now in today's world, illicit actors are increasingly relying on indirect exposure. So they are now using front companies, nominee structures, layered ownership arrangements to obscure control and economic benefit. At the same time, the evasion techniques have become more behavioral in nature. So rather than maintaining, long standing structures, they are highly adaptive, making changes quickly, involving rapid entity turnover, jurisdictional hopping, use of non-sanctioned, and this is something that we have seen from FATF and other regulators. So the use of non-sanctioned but strategically positioned enablers, such as professional services providers like lawyers or chartered accountants, and so on, or even some of the logistics intermediaries, for example, your shipping companies and shadow fleets is in the topic itself. So using all of those is becoming more and more common, and especially in the case of maritime linked cases, financial risks often emerge not from the vessel itself, but from the financing of it or financing of the transaction, the insurance around it, payment flows connected to a particular trade transaction. So basically these developments highlight the limitations of static screening approaches that, let's say, for the last couple of decades banks, financial institutions have focused on, and are now reinforcing the need for relationship and behavioral based intelligence.
Thank you, Rohit. So, just based on your what you said, what do you think is the most underestimated risk channel right now? Is it customers? Is it transactions or something else?
Like I said, sort of pointed out, so in last couple of decades, significant progress has been made in customer onboarding, transaction monitoring, and so on. So most of the financial institutions have a very robust framework, tools, processes to manage that. However, counterparties, extended networks, they basically remain the most underestimated sources of financial crime risk. In many of the complex cases that we see today, the risk does not lie directly with the customer or a specific transaction that a financial institution may be exposed to, but with the broader ecosystem of intermediaries, facilitators, beneficiaries that are involved in that particular transaction. So it is no longer direct, basically. So it is a lot of it is indirect, adjacent to what banks have a purview in view into. So it is rarely executed through clearly designated entities, so by various regulators around the world. um, so the sanctions evasions in today's world flows through layered ownership structures, third party service providers, opaque trades, logistics relationships, and so on.
Right.
Yeah.
Thank you, Rohit. Jimeng, let me turn to you. And how
Sure.
much of what Rohit described are you already seeing? And you operate in a global financial hub like Singapore. So, from your perspective,
Mm.
how are you seeing these sanctions or geopolitical risks, and what kind of compliance challenges are they bringing to your day-to-day role?
Maybe I follow up from what Rohit mentioned about underestimated channels, but I think there is something in which the entire industry still need to grapple with, um, primarily in terms of counterparties. So our customers, from a business point of view, they would always have existing as well as new counterparties. But what is being observed, especially since February 2022, aftermath of the Russian sanctions, etc., shell companies are always kind of incorporated. They can be incorporated months ahead of a sanction, or in a case of Russian sanction evasion back then, they were quickly incorporated weeks after the sanctions imposition. And I guess the challenge is trying to determine, uh, they call it the lemons market. You can't really determine which company is legitimate or not. And I think that remains a very critical risk, and a point that I think we can explore further in a conversation. Yeah. Now, back to the point in terms of the sanctions and geopolitical risk, the challenges. One thing I'm quite sure for some banks, especially when you have got customers who are global or even regional traders, there's this thing about conflicting sanctions regime.
Mm.
So you'll find that there's a transaction, technically speaking, might be legal if you are dealing with the European Union regime or, in fact, the Chinese regime. But given the vastness of the OFAC regime, then you find that, hey, it might be a contravention either from a primary or secondary sanctions regime. And then the challenge is legal opinions as you seek to uncover have different interpretation. So it becomes a real challenge practically for compliance officers as to how do you react if, let's say, it seems to contravene one country's sanctions regime, but vis-a-vis another, it is not, etc. And the second part of it, which I think very challenging across all banks, regardless of your stage of sophistication, ongoing, right? You'll find that typology change. But the question is, from a compliance perspective, right? How does one, uh, be it you're in local office, you're regional or global, right? Make sure that every part of the bank, all relevant stakeholders are being kept informed of the changes. And one thing for sure, in most banks, you definitely have the enterprise-wide financial crime risk assessment. But how to translate that document, which is essentially very static in nature, to something that is dynamic, very difficult in practice. And the other point to it is, how do you detect a shift in trading patterns? Not easy, because trade data comes in volumes, thousands and thousands of them. So even if, let's say, there's a real change in geographical risk distribution, including your counterparties, right? The sure mammoth volume and values, right, totally throw you off track. Okay. And if I go on then to correspondent banking, I think for those who are familiar with correspondent banking, it's always a historical nested relationship. All right. And I think the risk issue here is, it is very hard to tell if your supposedly safe respondent bank, who is in a rather neutral territory, right? But who knows? This bank or banks might potentially be facilitating trades for a sanctioned neighbor. You can't tell until you deep dive. And purely from a correspondent banking CDD KYC perspective, what we observe from the industry is it's getting challenging every year. So your major correspondent banks, be it USD, Euro clearing banks, they subject the banks to a lot of intensified due diligence, be it filling up forms or getting on a call. But there's a lot of focus really on, hey, whether as a bank you have got any sanction exposure, whether historically you have got the customers, or have you inadvertently uh, potentially having dealt with sanction oblique indirect sanctions. And I find increasingly in the last 2 years, a lot more questions being asked on digital assets players. Which I think there's always a nexus between the digital space of things in relation to sanctions. Yeah.
Thank you, Ji. Make some very, very interesting points, and we'll come back to that. But I'd
Yeah.
like to turn to Ryan first. Coming from a digital bank, the speed of transactions has changed for most banks, but from a digital banking perspective, I think the high transaction velocity plus the limited face-to-face interactions with customers, that's probably going to be even more challenging in your case. So, what we'd like to know from you is, how does this change the nature of financial crime risk, particularly in the context of sanctions exposure or the counterparty risks that we're talking about? Right.
Yes, thank you, Arpita, for that question. Actually, when it comes to digital banks, especially here in the Philippines, just recently we're in the digital banks here in the Philippines are quite new in the new players here in the Philippines. So most often than not, most of the target players or customers of a digital bank at the moment is more of a the unbanked customers from the far-flung areas. With regards to the challenges that the digital bank now exposed in comparison with the traditional banks is mostly on the easy account opening, because in traditionally there is a face-to-face contact with the customer, and also when it comes to transactional base, it's more of a business hours. But when it comes to digital bank, it's an easy account opening, and eKYC or onboarding can just take you 5 minutes maybe or 10 minutes, depending on the number of informations that the digital bank would require from the customer to be onboarded. And when it comes to documentations, it's harder to spot the impersonations when it comes to documents. And when it comes to because at the moment, the more high tech the business is or the banks is, those cyber criminals are also having the edge to leverage their knowledge or skill set when it comes to digital or cyber related activity. So in this case, when it comes to what's the impact on FinCrime risk on this one? Well, as I mentioned, it's harder to spot the impersonation and the deepfakes of the documents. Even those um, artificial intelligence is now being used when it comes to onboarding certain accounts, especially those involved in opening mule accounts. It's being used nowadays. So it's a matter of how stringent your process is and the technology that is being used, and of course how in the effective of the investigations or those people involved. Because the most important is not really rely on the system itself. Well, definitely it's a good to have a system in place. However, even if you have the good system, if you are not equipped with enough uh, knowledge or skills when it comes to investigations, that would break down. So what's the challenge when it comes to this one? Well, as mentioned, it's more of the real-time screening process. When it comes to transactions like this, um, you have the fast movement of money from one account to another is just a glimpse of seconds. So there has to be, a system that could you that there's a gateway to eventually stop or possibly freeze the transaction while it is being screened. So it's a real-time screening. It's more of the API-based screening in order to somehow leverage the fast movements of the money. And of course, the weakness at the moment is traditionally it's more of relying at the moment on a selfies and ID photos. Well, that's the traditional way of onboarding when it comes to platforms. So for this one, that's the current challenge on some digital platforms, not just from the digital banks, also with the wallets, especially those new players. Of course, we also consider the aspect of cost because as technology becomes sophisticated, the cost is also sophisticated. So we also have to consider those aspects. And also, um, what are the things that currently being used to mitigate? There are some institutions use the what we call the liveness detection or the motion movement when it comes to, because before we usually use the one-stop shot of a camera to have that image captured. But recently, it's more of a movement. So there's a we call the motion image
Mm.
capture. So that's the one I recently know when it comes to controls that is usually being used. And when it comes to monitoring, it's more of the automated monitoring system, particularly on addressing those sleeper accounts, which is being used especially for cyber-related activities, and also
Right.
those innocent victims that is being in relation to identity theft, because that's the higher number or percentage of customers are
Right.
now facing at the moment.
Okay. Thanks, Ryan. I think we have a good, idea of the spectrum of risks and challenges that, we are dealing with here. So at this point, I think I'm going to ask my team to launch our first poll for the attendees. And the poll is on which of these is the hardest to manage at the moment. And we have some responses for you to choose from. So let's give them maybe 30 seconds and then I'll ask your opinions on what you think came out at the top. Okay, can we publish the results? I think there's a almost a tie between mule accounts and virtual assets being the hardest to manage. Any quick opinions? Rohit, Chimeng, would you like to?
Yeah, I think it is definitely true. Scams and mules and whatsoever, although they appear to be the most common, but trying to stop it, uh, not necessarily easy, and there's many reasons for it. And I think one of this is the typologies keep changing, and more important also would be the criminals they recycle their typologies.
Mm.
So when you thought that something has come to the end of the road, they start to reuse what has been used before. And on cryptos, I can understand why, but again, my personal view, the actual impact of trying to manage digital assets from a banking perspective, it might not be really or deeply appreciated. And on the other side, for the non-fiat service providers, yes, although they come under different regulations, but to the extent that their controls are as robust per se, is something I think remains to be seen. Yeah.
There's a
Yep.
very
And
interesting comment here. Sorry, Rohit, before that, there's
yeah.
an interesting comment by Praveen Dayal, who's one of our trainers. Praveen, good to see you online. He says there should be an option, all of the above. Yes, noted. Yes, Rohit, you were saying.
No, absolutely, and I agree with Praveen. And to a large extent, all of them are interrelated. And I'll take one example. So the two top choices, mule scam, mule accounts, and crypto or virtual assets, they are also interrelated. So digital assets, sorry, virtual assets and cryptos, they obviously came up in last 15, 16 years after the famous white paper that was published in 2008, 2009 by Satoshi Nakamoto, which basically heralded this revolution. Given it is so new, it is also very easy to commit scams, make people fall prey to scams, or get them to be a mule for something else, uh, right? Because there are very limited controls. Obviously things are improving, things are changing. FATF has taken note. Several regulators around the region are also adding controls on crypto exchanges or other crypto virtual assets. But as of now, the controls are not there, or not as robust as our traditional financial institutions. So it is easier for people to fall prey. There is limited identification information that is available, that is collected by any digital exchange or virtual exchange, for example, when onboarding a customer. So that also makes it sort of pseudo anonymous. So that makes it tricky for anybody, investigators, to keep a track of what is happening. Um, Third, I would say there has been, because the cryptos or the value of the crypto coins or Bitcoin and so on, they have increased by so much in last 10, 15 years. It is easier for people to fall prey to get rich quick schemes. So that leads to, again, scams, mules, and so on. So all of those pose a big challenge to financial institutions. And finally, the cross-border nature, or rather, there are no borders when it comes to virtual assets. They are not licensed by one particular geography, one particular jurisdiction. So they can move like immediately to different jurisdictions. So that makes it super tricky to control and to manage sanctions evasion using crypto assets.
Right, right. So great. So team, let's stop sharing the results. And Rohit, I'm going to stay with you. You know, you were talking about identifying hidden linkages, right?
Mhm.
In your earlier response. So many institutions are still struggling with that, with identifying hidden linkages from corporate structures or maritime networks. So, you know, what kind of practical enhancements in screening or data integration have you seen to be proving most effective in uncovering these connections?
Right. And I'll reference some of what Ryan mentioned earlier. So data, availability of data, integration of that data across multiple systems, across different parts of the financial institutions landscape is important. So the most effective improvements that we are seeing, they are not necessarily about adding new data sources, but to make sure that there are better integrations and contextualization of the existing data that is already available. So the institutions that are able to combine screening data with corporate ownership information, adverse media, transaction patterns, historical relationships, they are far better positioned to uncover these hidden connections. Some of the some of the practical enhancements for this include one, for example, improved entity resolution to manage aliases, name changes, historical identifiers. This also helps with reducing the false positives. And we know how big of a problem that is in terms of the volumes, and especially for digital banks or in today's digital economy. Second, adding ownership and control enriched information that goes beyond only the shareholding part of it. As we saw, there are a lot of front entities, shell companies, and so on. So shareholding or having the shareholding information will get you only so far. Third, regular, not even regular, real time, and again Ryan also mentioned this, real time relationship tracking and monitoring across customers, their counterparties, and the various assets that they hold as far as possible. And then finally, visualization tools that allow investigators to quickly understand how what are some of these complex networks, how are they evolving, and who are the different entities, actors in this. So it is very, very important to move away from siloed control. So treating sanctions, AML, trade related risk as separate domains, which it has been done so far in most of the financial institutions. So doing that makes it far harder to detect this interconnected exposure. So a more holistic life cycle based view of risk basically will deliver better outcome.
Right. Thank you so much, Rohit. And Gmeng, I'm gonna, bring in the maritime risk that, you were speaking about also earlier. And trade
Yeah.
finance is often highlighted as a key vulnerability area. So, what kind of practical red flags or
Hmm.
patterns related to shadow fleet or maritime linked risks can compliance teams be more alert to in this current environment?
Okay, it's an interesting question. Maybe I reframe it a little bit because to answer that question, however academically possible to just regurgitate all from the internet, right? Your AIS spoofing, manipulation, etc. But why I want to reframe it because we need to do I think what is happening now actually is a very good reminder that risks and controls are not static. In peacetime situation, which is hopefully most of the time, you find that whatever framework controls you put in place, they address the so-called known risk and you go about doing it. However, when you have things that happen in the past 2 or 3 years, including the most recent tensions in the Middle East, they are no longer your peacetime situation. So if, for example, I go and teach a group of compliance officers by saying that, okay, you should take note of a high risk port of calls. So when you have got a frequent visits to those ports which are high risk, those you can identify as weak AML controls, you need to pay attention. But this is tactic. I think any practical officer will ask you, all right, if after I've identified that indeed this vessel has called on high risk port of calls a few times, what is next? I guess the what is next is something that stumped people, all right? So therefore, in my opinion, is it is important to know the reflex, but I think we need to go beyond trying to identify reflex. They are important, but we know. But in current circumstances, if we intensify the kind of analysis, right, in addition to identifying reflex, then we need to determine at least two things. Firstly, what does a red flag or what do red flags mean in a specific situation? Meaning that from a case-to-case basis, it may have a red flag may have different iterations or interpretation, right? And therefore, that comes to the second point, which is important. Each red flag, each indicator, actually, from a practice point of view, is actual risk weight differs. And I guess the practical thing from a banking perspective or whichever is going back to my earlier point, right? Is when there are things that happen internationally, regionally, how quick does the compliance officers react and then able to accord the right advice in terms of reflex? So then the second thing is, I think important, although this is no longer secondary school, understanding geography is important because we need to know the high risk geographies. And let's say the Gulf of Oman, for example, known for historical transshipment of Russian oil, or even certain parts of waters near Malaysia and parts of South China seas. They're also known for ship-to-ship transfers of Iranian oil, Venezuelan, as well as Russian cargoes. And not to mention things like the Sea of Japan, the Gulf of Finland, etc. So these are things that need to be sensitive to, because whenever there is an event that happens regionally or internationally, the reaction takes place in terms of a change route. Let's change the mode of payment, etc. So knowing the different geographies, and back to my earlier point, right, from a correspondent banking perspective, what may appear as a neutral, a safe country, the banks in a neutral country, maybe in a certain sense, when things happen, right, they may become a very good conduit for funds to be layered through because the attention is not there. Now, then a third point which I cannot either under or overemphasize is documentation. When it comes to trade, documentation remains very important. And one point that comes to my mind, in current practice, banks, I think most banks, when it comes to certain trade or certain size, they would engage IMB. They validate the bills of lading. But one thing to caution, even though the route could be correct, purportedly shipment, etc., but when it comes to the documentation, do take note that things like misinvoicing remains actually very real. Meaning that a cargo might have been actually shipped, but to the extent whether the cargo prices are consistent for what they are, right? Uh, Sometimes may not be, etc. So going beyond trade financing, I think linking back to digital assets is in the past few years gaining traction. Apart from a traditional financial institution payments, right? There's increasing focus on decentralized finance. The model is very different, and in fact, if you look at the whole payment chain and correspondent banking, unfortunately, to some extent, it is very heavy. Whereas from a blockchain financing perspective, it cuts away of other unnecessary things like the intermediary banks, etc., etc. So then, from a pure bank perspective, I think the advice is compliance officers needs to really understand digital assets and things like stable coins, etc., how relevant they are from a payments and settlements perspective. Yeah.
Right. Thank you. So what I'm taking away is, the ability to move beyond alerts and develop more meaningful sort of intelligence-led insights. And I'm going to ask Ryan to comment on that. You were also talking about building investigative capability into your teams. So in the previous response, we were talking about the challenges, but can you give us some insights on how you are actually building this investigative capacity within your teams, and what kind of gaps that you see that need to be really worked on?
Yeah. Well, currently, with the vast increasing of the cyber-related crimes, specific, though this more of a jurisdictional in nature and also institutional, because that would depend on the controls that are in place in every institutions. But for a digital bank, currently, we're talking about how are we going to address those gaps. When it comes to gaps, it's more of the stream based screening or the real-time control, real-time screening or monitoring. But those real-time screening, it has to be added with the analytics, whether it is an AI driven or what, because this is more of advanced when it comes to addressing those transactions, because in a digital bank with a high velocity of transactions, and also it's actually a 24/7 transactions, and with those you are just given seconds to assess those transactions, and you have to cope up with those fast movement of transactions or money from one account to another or from one institution to another, because by the time that you are already reviewing those transactions, the money is already gone. So in any case, those kinds of behavior at the moment should have to be addressed. Not just, it's actually in a combination of risk scoring. It has to be dynamic. um, the scoring of based on the traditional way, it has to be included more of transactional risk scoring instead of static based on the profile of the customer, because the technology and the mindset of the people is actually changing. So especially those cyber criminals, when they know that the control of a certain institution um, has upgraded, they will also upgrade. How will they, uh, decriminalize those actions, and also to leverage and how they will look into um, those victims. So when it comes to addressing those gaps, especially on what I've mentioned a while ago, is the education campaign, not just on the people within the financial institution, but also on the customer's side, on how what are the controls that they need to look into. And when it comes to system, um, it's already have to be um, dynamic. Those from the fraud team or from FinCrime, the AML, the sanctions team has to be talk to each other, not just physically, but it's more of the system. It has to be embedded from one system to another, because the transaction has to be filtered depending on the rules that is being embedded in the system. So definitely those three systems or more, fraud, AML, sanctions, it has to be one it has to be one catch all. When it comes to transaction, those alerts should be captured depending on the scenario, depending on the rules that you have did. Because at the end of the day, it's not about the rules. It's a matter, it depends on the response, because the quick in response will address those gaps, because we are no longer in a we are no longer in the age of batch processing, or by next week, or weekly processing, but something like that, because that's too traditional, wherein the movement of the money at the moment is very fast. So at the moment, the one gap that should have to be addressed in this one is the feedback mechanism as well. There has to be open communication when it comes to addressing those fin crime related activities. So the bottom
Right.
line, it's more of the edge comes from the fusing identity.
Right. Thank you. And let's bring in our audience also at this stage, and let's launch the second poll on what do you see as the biggest gaps in your current financial crime risk strategy. And while the audience is providing their opinion, Rohit, I'll pose a question to you, and you can think about it and maybe answer once we close the poll. There's so much talk about, AI and related technologies and a lot of move towards automation. But, given this increasing volume and complexity of data that, both Jimeng and Ryan talked about, how should institutions really think about balancing automation and human judgment in financial crime detection? So stay with that. And once we get the poll done, maybe you can actually answer that.
This is even closer than the previous one.
Yes, yes, indeed. And Ryan, what you were saying about disconnected systems and data silos, that seems to be currently the biggest gap.
Well,
So can
yeah, as mentioned a while ago, it's more of the presence or the availability of data from one system to another, or from one data centers to another. Because if you only concentrate on what is available without, using the open source system, then definitely there's a danger when it comes to misjudgment of specific, personality, or even the transactions, especially when it comes to cross-border transactions. So it's a matter of the sources that are available when it comes to decision making, and of course, the like I mentioned, the education campaign, or the how equipped the person investigating it, because that will dwell on what kind of the result or the outcome of the investigation that will result on it.
right. Thank you. Rohit, your views, and then maybe you can answer the question that I posed to you.
No, definitely agree with what Ryan said. And this is also not just about the information available externally, but also the banks systems within the banks. They are also not always talking to each other. The legacy tech stack that we have for core banking system, for transaction processing system, for a trade finance platform, there are again that creates silos. So the information, or all of the information, is not available in one place to sort of get a single view of the customer. So definitely a big challenge that we see while talking to the banks in the region, working with the regulators. So yes, and I am coming to the question. I am surprised we are in 2026 and it took us 36 minutes to for one of us to mention artificial intelligence. That was obviously Ryan, but that's a surprise. But coming to the automation and human judgment, that is definitely true. So because especially for digital banks, but otherwise also, so we are in a digital economy, as I mentioned earlier. So the data volumes are increasing, the number of transactions are increasing. Most of the people have multiple bank accounts, multiple financial relationships with other financial institutions. So the complexity continues to increase. In this scenario, automation and human judgment sort of would play a complementary but differentiated roles. So one cannot replace the other, and any regulator will tell you that, right? So automation is especially highly effective when it comes to scale. So it can automated systems can process transactions or data at scale. They can identify weak or indirect signals, prioritize some of the areas that should be looked at further. So what are some of the areas of concern? And this is where artificial intelligence also comes in. So it can identify based on the patterns, based on the previously unseen information, not unknown, but unseen information, which might not be visible to a human eye. AI can help with that. After once that is done, human expertise comes into the picture, and it remains critical for interpreting that ambiguity, exercising judgment, and especially proportional judgment, right? Because you again have to take a risk based approach, and you have to make sure that financial prevention of financial crime does not impact financial inclusion, especially in a region like ours, where that is also one of the key priorities for the regulators. And where human judgment also comes into picture is ensuring regulatory defendability. So we can, if a question is coming from the regulator on why a particular decision was taken, we can defend that, and we can provide data points or information on why this was the case, especially with respect to sanction based decisions. So in that sense, the goal should not be the full automation of outcomes, rather automation of insights. So automated systems, artificial intelligence, they can help you generate insights on which a human can take decisions. So what this will do is it will prioritize, reduce the number of false positives, or reduce the number of matches or question alerts that human needs to look at. So this is what we are seeing across leading institutions. So they are now using technology to reduce that noise, to add more context, and to enable investigators, going back to Ryan's point, to enable investigators to focus their attention where it is most needed. over automating decisions is obviously not the right approach. It can create unintended consequences while under investing in investigator capabilities or the tools that they have. So, to sum up, in practical terms, the most resilient operating models use technology to inform decisions, but they still keep accountability and judgment firmly with experienced professionals.
Right. Thank you. And taking regulatory expectations from your point, and Jimeng, if I can ask you about
Mm.
how regulatory expectations are currently evolving. What
Mm.
are they expecting from banks in terms of demonstrating effectiveness around, sanctions compliance or financial crime risk management? And you are in a jurisdiction where the regulator is one of the strongest in the region. So, can you share some insights on what's happening?
I think when it comes to effectiveness, is always a challenge. So I think at a high level, what we all can agree is that from a regulatory expectation and how the industry response is, we have gone beyond telling the regulator, I have got all this. I've got the policies and procedures. I've actually implemented machine learning. It's actually beyond that. So when I talk about effectiveness, I think the very baseline that the regulator is looking at is, tell me what value have your tool or tools essentially help to prevent or detect. And it's a tall order, right? I think increasingly for the past 3 years, regulators across the globe, especially the more advanced one, has been trying to push banks towards predictive detection models. Not necessarily easy. Okay. And other areas in which it is very easy for any financial institution to basically turn a blind spot to. In all countries, there's always the national risk assessment. There's always the country's financial crime priorities. And some institutions effectively were happily developing their AML-CFT technologies, framework and controls, which is good. But at the end of the day, what the regulator really wants to see is whatever you develop, you need to tie back to my national risk assessment and my priorities. You cannot be doing whatever you think is the in thing or you should do, but how does it address the so-called national or even regional geographic risk? The second part is, again, a tall order is an assessment of how quick response time and FI response to financial crime typologies. And going back to the earlier discussion, it is if for those institutions whereby the risk assessment still remains very static, then when things changes, how do you demonstrate that I've actually incorporated this into my control framework, guidance papers, etc.? And for institutions that are deploying artificial intelligence, many areas to consider, but again, at a very high level, there's always you have to have that model explainability. You must be able to explain how the system come to a decision or why it decided not to. And the second part of it, which is very technical, is data changes, profile changes, behavior changes. So the regulator will be constantly trying to understand how does the institution address the so-called modeling drifts in terms of the concept and data. Last but not least, not only will the so-called compliance department, the BUs, be subject to scrutiny, management and for banks with boards, right, they would also come under scrutiny because they will look at the minutes, they will look at the quality of the presentation to see if anything significant has been presented, whether any of the board member has actively challenged things like that. So in a nutshell, assuming if you just imagine tomorrow a regulator walks into a financial institution, whether announced or unannounced, there's a few things probably is on the top of the mind of the regulator, which the institution needs to address. Perhaps firstly, right, whether the institutional risk assessment reflect the actually country's financial crime priorities. Then the second thing is, although regulator does not impose, right, but they are also very interested to see if the institution concerned devote sufficient resources to areas that most needed it? And last but not least, then the thing is that, okay, what is the quality of the STRs? How have they changed? Is it still purely form filling, or is it just updating the police or the regulator on typologies, or have it led to, very important, uncovering of a greater network for which the information might have a national impact? Yeah.
Thank you. Some very, very interesting insights. I think we are, closing in on the end time. So I think it's time for some questions. But before that, a very quick announcement. Fintech and the Asian Bankers Association is hosting a regional workshop on 11th and 12th June in Bangkok. That's going to be on fraud management, dealing with scam centers, mule accounts, and virtual assets. I think it'll be a very practical, comprehensive 2-day program. My team has already added the link to chat, so interested attendees, please look it up. Moving to questions, I think there are quite a few interesting ones in the chat. I'm going to start with one from Thivakar Raghu. How effective do you think the counter sanctions imposed by countries such as China and Russia are? Would consider them in your investigation since most jurisdictions follow OFAC sanctions primarily? If so, what are the points to consider from this? Jimeng, you alluded to that when you were speaking. You were calling it, conflicting sanctions regimes. So if you can
Yeah.
elaborate a little bit more for Raghu, I think that will be good.
Uh, it's an extremely challenging question because we can, okay, in that question actually is a real operating question, but behind that question, right, it has got more heavy centric in terms of regulation and even from a country perspective. So if in a nutshell I choose to ignore the US OPEC, why not, right? If assuming theoretically I don't have exposure in US dollar, which is quite impossible. And the nearest you come from is that maybe you don't have a US subsidiary or branch in US. Don't forget, if let's say really, just for the sake of just articulating, if let's say the US authority were to want to actually fight for the mere non-compliance of OFAC sanctions, even though it may not impact on a so-called far-flung jurisdiction somewhere else, but the US branch or subsidiary may get implicated. But the long and short of it is, I suppose, I won't say there's a right or wrong answer to it, but definitely, I think based on practice, uh, you always have to refer back to your own country regulations as the starting point, whether there's any prohibition. And from there, you have to look into that particular transaction in terms of currency. I'm not asking to circumvent, but the currency itself has a nexus. If it rightfully involve a USD currency, unfortunately, extraterritorial, right, you're bounded by it. But if for example, that settlement was in another currency, then would that be possible? And if your answer is a yes, then you still need to address the residual risk. Am I being seen as circumvention potentially? And secondly, any other risk of secondary sanctions? Yeah.
Very practical answer. Rohit, do you have anything to add on to that?
Uh, Honestly, nothing further than what Jiming said. But to summarize what he said, risk-based approach, depending on what your exposure is, I think a financial institution needs to take that call.
Yeah.
Right. The classic AML answer, risk-based approach. Ryan, there's one question that had come in when you were speaking about, the risks about onboarding and such from Malini Ramdhan. How would you manage such risks while encouraging digital innovation and a safe digital environment? Would you like to take that one?
Yeah, sure. Um, well, when it comes to digital banking perspective, on a compliance perspective, it's no longer more of you know closing those alerts particularly. it's more of how were you able to investigate it. That's more of a compliance perspective. It's no longer of how many alerts were you able to close in a day or in a week, but rather how will you build cases and intelligence when it comes to those alerts. It's a matter of substance over form, because the pressure when it comes to the investigators is how will they be able to catch up on a day-to-day alerts. So it's a matter of case build up at the moment, because before traditionally you have to close, well, okay, I already closed all those alerts already, but what's the expectation on this one when it comes to uh, customer perspective? It's their building trust when it comes to how were we able to safeguard their monies or funds and their personal informations. And also it's a matter of uh, well, just like they mentioned a while ago, it's more of a judgment. So it has to be on a regulator perspective. It's more also because I mentioned a while ago on a compliance perspective and then a customer perspective. With the more and on a regulator perspective, it's more of how did you investigate it. It's not more of how were you screen those data points. So it's not about rules, it's about response, because the rules are there. You can always put all those sophisticated rules in the system, but how about the response time? So
Yeah.
it's crucial when it comes to a digital banking, because the fast movement of money is just a glimpse of seconds. You can no longer return the money, so something like that. So it's not
Yeah.
it has to be dynamic. So
Right.
that's all of my
Thank you. Thank you. Thank you. I'm going to take one question from Melody Nebriaga. And Rohit, perhaps you can try to answer this. It's about open account transactions. So the question is, vessel information is typically disclosed in bills of lading and is therefore more readily available in trade finance transactions such as letters of credits and documentary collections. Given that open account transactions generally lack standardized trade documents disclosing vessel details, how do other jurisdictions implement vessel screening and or detection of shadow fleet activities in the context of open account trade transactions? Rohit, would you like to answer that?
Yes. So, like Melody said, definitely tricky because that information is not available. I think the answer to this question lies in going back to the customer, so who has that open account, and working with them to understand how they are using that open account. And in cases where it is needed, getting that additional information, doing that extra due diligence when it comes to the transactions that are happening via that open account. So even though this information may not be readily available, may not be available at the beginning or during the course of the transaction, I think the financial institutions will need to work out or improve their processes, enhance their processes to get that additional information to make sure that they are not missing any risk. As Jimeng also pointed out, there are a lot of maritime risks that we are seeing, and especially in the region around the straits between Malaysia, Singapore, Indonesia, in the South China Sea, in South Asia. So a lot of illicit transactions happen here. So ship to ship transfers or dark activities, things like that. It is very, very important for financial institutions to be aware of the risk that they are exposed to. So short answer is they need to get that information, do that extra due diligence, and then use that information to make sure that they are managing their risk properly.
Right. Jimeng, do you have anything to quickly add on this particular case?
I think it's no easy answer because in and it depends on which are your customers, right? In practice, I just have to share there's many ways to structure a trade such that even if your customer is complicit, your customers can actually present to the bank by saying that ultimately, for example, the goods are actually collected on a X works basis. I'm just a broker in a transaction. So if you're asking for documents on shipping, etc., I can't. If you need invoices, I can. So back to the question, I think we all recognize currently going through the route channel of like LC's dog collections, they probably occupy 20% or less, but the main bulk of the settlement is disassociated with the actual shipment of goods, is on payment system. So the way to address it is really apart from whose muscles are stronger, whether the customers or the bank, right? You just have to have a very distinct uh, identification of risks per customer, also based on what kind of goods and services, as well as the type of payments that will make, in which case it will make your detection much more precise. Yeah, you're able to fish out those supposedly higher risk transactions and higher risk customers. Yeah.
Right. Thank you so much. We are actually out of time, officially out of time. I think we do have a lot more questions. I'm so sorry we could not, take up all of them for answering. But thank you so much, Jimeng, Ryan, Rohit, for that wonderfully insightful discussion and for being so candid in sharing your views with the audience. Thanks again to LexisNexis Risk Solutions, particularly to Pri and Rashi and Rohit for, if you're listening, Pri and Rashi, thank you for collaborating with us on this one. And friends, hope to see you soon at the next Fintellect program. Wishing you all a great day ahead. Thank you so much.
Thanks.
Thank you.
Thank
Thank
you.
you.
Keep safe, everyone.
Thanks.